More Business Briefing right now on FM News 101.
And moving past the bottom of the hour after what was, without question, an epic week across America. And as the dust settles now, hopefully everyone is coming together and working together. What will a Trump presidency mean for taxes for business owners and executives? We bring in Michael Lortz from Geffen Messer to talk about that, and everyone across Oregon breathing a sigh of relief as Measure 97 fails. Well, I know that corporations that do business in Oregon, Michael, are breathing a huge sigh of relief, right?
That's right, Brian. So Measure 97 was defeated. As you know, corporations with over $25 million of Oregon gross receipts were going to be subject to a gross receipts tax. These are C corporations, and if they had Oregon receipts over $25 million, they were then going to start to pay a minimum tax of 2.5% of that Oregon revenue. That did go down to defeat, but I think that's not the end of the story. I think the state's still going to be looking at other tax plans to try to find ways to deal with a projected budget deficit.
This tax was projected, as you said, to raise $3 billion per year, and if they continue to look at this, I know a little bit, I guess enough to be dangerous. Oregon, not necessarily one of the higher taxing states when it comes to these corporations, so maybe they'll come back with more of a middle ground, you think?
You know, I don't know what they're going to come back with. I think one thing is clear. The state's projecting, I think, a $1.3 billion deficit in the next biennium. There have been other proposals that are based on sales or gross receipts that would apply more broadly. So instead of just targeting these large C corporations, apply something a little more broadly. Effectively, might be a sales tax, might be something like Washington's B&O tax. But there is a lot of interest, of course, in changing Oregon's reliance on the income and property taxes and trying to add something else that's got a bit of a broader base.
Well, to be continued, I guess. That's the best thing we can say. Michael Lortz joining us here at Geffen Messer. We don't typically get political on the show, but we can't avoid it now. We've talked about this throughout the program. This weekend, Donald Trump, the president-elect, it's official now. And I know that a lot of your clients and a lot of the business owners and executives we work with already, a lot of chatter via email, text, and over the phone late this past week. You know, what's going to happen here? Let's talk about Trump's tax plan. Yeah,
so interesting. Election Tuesday night. Wednesday, we start getting calls saying, hey, should we restructure? What are Trump's tax plans and how are they going to impact my company? So that is something I've looked at. Happy to share some information about that today. I would caveat it by saying that most folks running for office at the national level tend to make a lot of proposals and promises as they're campaigning. The reality is legislation often looks a bit different. But Trump did provide a number of specifics during his campaign. And really, in some ways, those specifics are familiar. Reducing tax rates for individuals, generally speaking, and reducing the number of rates. So a simpler three-rate sort of system. I think the top rate would be 33% in his proposed system. And contrast that to right now, where the top rate is approximately 40%. Bigger changes on the business side. He proposed reducing the corporate rate from 35% to 15%. In fact, that 15% rate would apply to all business income, whether it was a corporation or some other type of entity that was conducting business. So a very significant decrease in the rate on business income. Another very interesting component has to do with how do you treat capital expenditures. As you know, when a company is buying equipment, typically they depreciate that over multiple years, which means they're claiming the tax deduction over multiple years. Trump proposed allowing companies to deduct 100% of those expenditures in the year that they make the payment, in the year they buy the equipment. So that would also be a major change.
Let's talk individually about itemized deductions now, too. This is something, again, simplifying it, I think, for everybody across the board, right?
Correct. So there are a number of aspects of Trump's proposals that remove benefits. And one of those is in the area of itemized deductions. Right now, high-income taxpayers will often have a lot of itemized deductions. Combination of mortgage interest, state income taxes, charitable contributions, and Trump proposes capping those amounts. In fact, he proposed capping the amount of itemized deductions at $200,000 for a married couple. Now, I realize that for most of us, that cap doesn't seem like a big deal because that might be more than our income. But for a number of our high-income clients, that would actually reduce their deductions significantly if it was capped at $200,000.
The first thing I thought of, those of you just joining us, Michael Lortz with us here at Geffen Mesher, estate tax. And that's been a big bone of contention between Republicans and Democrats going back years and years. Now we have a Republican president, Republicans aligned in Congress, and it would appear that they're going to repeal the estate tax or get rid of it, but they'll have something else in place, it sounds like.
Yeah, so that was another portion of Trump's proposal, which was to eliminate the estate tax. However, the way the estate tax works today is that you might be paying estate taxes, but when you receive the property as an inheritance, you now have a basis equal to the value of that property. So what that means is as you've turned around and sold the property the next day, you wouldn't pay any taxes. So if the estate tax is repealed, the opportunity to increase the basis to the fair value at date of death, that goes away as well, which means that ultimately there will be capital gains taxes on appreciated property. So you might escape the estate tax, but there could be a significant income tax component. And Trump's plan even alludes to a possibility of triggering those capital gains taxes on death. So a lot of these details would need to get fleshed out.
Let's talk about carried interest in 1031s. We've got time. Tell us what's going on.
For the real estate community, there's probably two topics that are sacred, and one of those is 1031 exchange, and the other is carried interest. 1031 exchange in particular, that's the provision where you can defer gains when you sell a piece of investment real estate and you buy another piece of investment real estate. That is something that both the Democrats and the Republicans have targeted as an area that they want to limit the benefit of or perhaps eliminate altogether. I was in a 1031 conference a few weeks back in San Diego. One of the lobbyists for the 1031 exchange industry was there, and his comments were interesting. He said, as long as we have divided government, we think 1031 is going to be okay. But if either the Democrats or the Republicans were to control, the Senate, the House, and the presidency, then 1031 might be in real danger. Well, now we've got government where it's all the Republicans at the national level. So Section 1031 might be in danger. We'll have to wait to see specific proposals.
Be interesting to see with a real estate developer as the president, right? Is he going to get rid of that?
Yeah, no, I've had the same thought. It'll be very interesting. The other thing that Trump talked about specifically in the campaign was carried interests. And carried interests are essentially a way for people such as hedge fund managers to convert some of their income from ordinary income into capital gain income. And really, it's the hedge funds where there's been a lot of outcry about abuse in this area. But it's also a provision that real estate developers use. Instead of getting paid a fee for their services, they will take an ownership interest in a real estate project, and when that sells someday, they get a capital gain, rather than having to pay taxes at the higher rates on ordinary income. So the real estate community cares about that as well. Maybe under President Trump, we'll go after the hedge fund managers and leave the real estate developers alone. I don't know.
Well, it's been encouraging to see what happened late in the week. I think things are starting to smooth over, and great to get an update from you, Michael. I know you're extremely busy. Good to see you, and thanks for your insight.
Thank you, Brian.
Always great to catch up with Michael Lortz at Geffen Mesher. If you'd like to reach out to him, his email, mlortz@gmco.com. Up next, we'll tell you much more about the Veterans Job Fair coming up next week in Tacoma.